You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion, delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We're a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we're celebrating today. We celebrate every day on Ron Siegel Radio. What do we got to celebrate today? National Quiche Lorraine Day. Who is it that said real men don't eat quiche? I don't know. I kind of like quiche, so whatever their individual issues are, that's their loss. Whatever. What else do we have to celebrate today? National Streaming Day. Josh, you into streaming? You're a streamer. Okay. I can't figure it out. I hate it. I mean, I've had YouTube, the YouTube TV. I've had, I don't know, a couple of, I think we've got Hulu now. My son works at Disney, so we get Hulu. I can't find the shows I want to watch. I can't, DirecTV, I go right to the channel. I had a guide on there. I can find things. I go to the YouTube TV. I can't find squat on there. I don't know what and trying to get it to go to the DVR so I don't have to watch commercials. Can you even DVR things when you're streaming? I don't know. It just drives me nuts. Okay, let's pick Strawberries Day. I just eat the strawberries. Let somebody else pick them. If I'm going to pay for them, I don't want to pick them and pay for them. Today's National Be a Millionaire Day. Wasn't that Regis Philbin, Who Wants to Be a Millionaire? Wasn't he the one that did that TV show? Okay, be a million. Hey, we got Ron Siegel Radio dollars here. So, Josh, I don't even know if I've shown these to you. We've got. I think I can get in serious trouble with these if I took them to Vegas. So they're $100 bills. They don't have Benjamin Franklin's picture on the front. They have my picture on the front. So and it's a big picture of my head, so it's quite obvious that it's not real American currency. But it does fun because it tells everybody what we do here at Ron Siegel Radio, so we enjoy that one. And I've got to have a little bit of fun. And today is National Rescue Dog Day. So Josh just told me he just rescued a dog. I love it when people rescue dogs. But I'm going to ask this simple question. My question is, what is your favorite breed of dog? What is your favorite breed of dog? So for 17 years, we had a black lab. She was great. Loved our black lab. Unfortunately, she's no longer with us. We have they tell me it's an Aussie Doodle, but I don't know what the deal is, because when I looked it up when I put her picture into that super secret website, google.com, it came back saying a Schnauzer Doodle. Don't know what that means either. So, big dogs or small dogs? Put it in the chat for me. And I see you guys all there. So why don't you just go into chat and just tell us, number one, tell us you're here. We like to see that people are live here watching Ron Siegel Radio. Helps with the algorithm as well. And also tell us what's your favorite breed of dog. Do you like large dogs or small dogs? I got a lot of fun with my dog now, but I must admit, I kind of like large dogs. My dog is a little tiny dog, and I like larger dogs just because she's so small. She's afraid of everything. Well, she's not really afraid of everything, but I don't know. She's a great dog, but she likes to trip me and all that because she's really, really hyper dog. But in any event, tell us, large dog, small dog, what's your favorite breed? Today is National Rescue Dog Day. And I will note, not that I get paid for it, but I found food coming out of Vegas, Josh. Badlands Ranch Superfood. I think it's in Vegas. My dog really likes this one. Okay, Rachel says English Bulldog and Labs. Good. We like, you can never go wrong with a lab. Other than the fact that they shed a lot. But English Bulldog. So my son and daughter-in-law have a French Bulldog, I think. Is Frenchie? Is that a French Bulldog? I don't know. It's a little tiny thing. But we have fun with dogs. Let's see what's going on in the markets today. The Dow Jones Industrial Average, are we going to check that one out? Is up 18.28. NASDAQ is up 18.13. The NASDAQ is up 112. Oil, 33 cents a barrel, is down a little bit. And the 10-year Treasury, that's up 2 basis points, 4.448 right now. Kind of surprised to see that there's not more activity in the oil market with the news that the president of Iran was in a helicopter accident and is no longer on this earth. I'm just going to go out there. I wonder if this was internal malfeasance. They say that the Ayatollah wanted his son to have this position, and this other guy, anytime someone gets into wants to challenge him, somehow they go missing permanently. So the question marks they're in Iran. So we'll see where that goes to. Moving right along, let's see what else is going on. Rudy Giuliani served an indictment in Arizona for fake electors case. I don't know whether the election was fabricated or not. There's no proof saying it was. The only thing I can say that we know with 100% certainty is you got to question the idea that the Constitution of the United States says that each individual state legislature has the authority to set the rules for that state's elections. It does not say anything about a governor making unilateral changes to what the process is. Seems to me that if it says the legislature, the founding fathers knew the difference between the executive branch and the legislative branch. Seems to me there's a little bit of question marks there. Now, have you seen what's going on in Florida now? Now they are finding that there's some question marks about the election in Florida. So I'm not Florida. I'm sorry. In Georgia, they are saying that those things that we saw with our own eyes, where the ballots came out from underneath the tables, might have been true. So we're going to watch all of that and more. You can reach me anytime. We're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, what's next for home prices and mortgage rates? Ways to establish a FICO score without applying for a credit card. Chat about that one. And 6 things to consider before getting an adjustable rate mortgage. We'll talk about that as well. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numero 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make that call, 800-306-1990, 800-306-1990. And every day at this time, OBMMI. They provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. They do not tell us points paid, points received, or APR. They tell us the number to put into your mortgage calculator. Oh, you don't have a mortgage calculator? That means you didn't go to ronismylender.com. We'll give you a free app, a mortgage app. Yes, it has the application on there, but it also has a mortgage calculator on there. Let's take a look and see what loans locked at on Friday. Conventional loans, 30-year fixed, 6.922 up. 30-year jumbos fixed, 7.216. That was up. FHA, 30-year fixed, 6.732. That was up. USDA loans, generally it's always the rural areas, but generally no down payment, 6.592. That one was down. And the best loan on the market for those that earned it, the 30-year VA loan, 6.47. That is all of the numbers that locked on Friday. If you want our market thoughts each morning, as early as the data allows, rsrmarketminute.com, rsrmarketminute.com. Put that out each day as early as the data allows. Let's take a look at what we're seeing for today. Now we've got the S&P 500 is now up 15 points. We've got the 10-year Treasury up 2 basis points. That's at 4.443. That's the interest rate or the yield. The mortgage bond is up 1 basis point. Means nothing's happening with the bond. When the bond price goes up, rate goes down. But when you're talking 1 basis point, it basically means nothing is happening. So the question is, why are we seeing what we're seeing today? And there is a lot of data out there that people are not talking about. So one of the things that we do see people talking about right now is the Federal Reserve. We've got a bunch of speakers out there right now, and we've got voting Fed member Raphael Bostock from the Atlanta Fed said that he thinks inflation will continue to come down, but slowly. He anticipates the economy to slow down. As he said, he talks to a lot of business leaders, and they're telling him that same thing. Leading economic indicators, another sign that the U.S. economy is slowing. The Conference Board released their leading economic index, which decreased in April by 0.6% after 22 months of negative readings in a row. This index turned positive in April, but they fell 0.3% in March and now 0.6% in April. Conference Board said that while the LEI, the leading economic indicators, 6-month and annual growth rates no longer signal a forthcoming recession, they still point to serious headwinds to growth ahead. They project that real GDP growth will slow to under 1% over the second quarter to the third quarter of 2024 period. If we do see the economy continue to slow and even recession-like conditions, it would likely be helpful for inflation and mortgage rates. And I'm going to tell you that, there are a lot of areas where the market is really telling us we're already in inflation. We're already in recession. We are already in a recession. Some of us are of the belief that we went into a recession back in October of last year. And remember, the Economic Research Board, who calls the balls and strikes on recessions, they're always behind because you have to be looking at the data, and that's what's going to tell you whether we were in a recession or not in a recession. So the bottom line is when we start talking about these things, it's always lagging data. So some of us do look at forward-looking data. What do I see in some of the forward-looking data from some of the services? Well, parents, right now we're in graduation time. Many parents are experiencing the bittersweet moment of their child graduating high school. The job market for new college graduates is facing some challenges with a notable decrease in hiring and rise in unemployment rates. This means it's more important than ever to be prepared and strategic about entering the workforce. Two key economic indicators, the SAM rule and the McKelvey rule, suggest that the U.S. economy might already be in recession. Where did we hear that already?
Surprise, surprise, surprise.
These rules track unemployment rates and their increases, indicating economic downturns. Currently, a significant percentage of states are showing signs of recession, impacting job security across various sectors. Manufacturing and leisure and hospitality sectors are showing signs of slowing down. Job insecurity in these areas has been increasing, which can lead to fewer opportunities and wage stagnation. This trend is seen as disinflationary, means it could help reduce overall inflation rates. Housing market is also experiencing shifts. Demand for vacation homes has significantly decreased, and primary home buyer traffic is down due to high interest rates maintained by the Federal Reserve. This has led to fewer mortgage applications and a decrease in home prices. The market is seeing longer days on market for listings and an increase in active listings. What does this mean for you? First-time home buyers and homeowners, understanding these trends is crucial. Here's some tips. Stay informed. Watch Ron Siegel Radio or get on our market report, rsrmarketminute.com, rsrmarketminute.com. Plan your home purchase or sale carefully, considering current market conditions. Consult financial advisors or real estate professionals to make well-informed decisions. These are all some of the key points. That actually happens to be some of the commentary that we put out in our report this morning. And I'm just going to share with you that there are a lot of these issues out there, and take advantage of what opportunities there are. I'll tell you about them in a minute. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call. 800-306-1990. 800-306-1990. Wanted to just throw a little bit out there at you, because as we see some of these challenges in the housing market, I'm going to ask you, instead of looking at these numbers that come out, and I share with you all the time data from the Bureau of Labor Statistics, I call them the BS reports, because they're always so far off that they've got the revisions that come out the month later. What does it mean when they do these revisions, though? Because as a consumer advocate, I'm going to tell you, they hurt you. Why? Well, the market trades based on the headlines. So if we get a report that says that we created a lot of new jobs, that's what the market's going to trade on. It's going to trade on the fact that there's a lot of new job creations, whether it's accurate or not. The next month, when we get the revisions, the market doesn't go back and say, oh, you know something, we were wrong. And all of you that made business decisions, and I call it business decision, anything that's a financial decision is a business decision. Deciding to buy a house, sell a house, finance a house, refinance a house. Those are all business decisions. So you make a business decision based on bad data. You don't get to go back and say, you know something? The market, the interest rates jumped a lot, and they shouldn't have, because the data wasn't really as strong as it looked. You don't get to go back and say, you know something? I think I should have a lower interest rate. You're stuck with that higher interest rate for the next foreseeable future until it makes sense for you to refinance, restructure your loan. Just throw that out there for you. Be careful. You have to really watch what these things are. Understand what's going on in the marketplace at all times. And I'm a big, big believer that we've got to really go be looking closely at what is happening in the marketplace and why. So I share the data that we're looking at from various services that I pay for, and then I cull it down and give you what I look at as being the most important issues of the day. Now, as we're looking at more and more challenges in the market, one of the things I want you to really be aware of is take a look at what we're seeing when we get to the concept of job stability. So I've talked to you before, and we talked several times. We've had Todd Ballinger on. We've had Doug Waldman on, talking about Geneva's Home Select loan. And you can go to rsrhomeselect.com, rsrhomeselect.com, and find out everything you need to know about the Home Select loan. Or if you don't find out everything you need, you can ask me questions about it. But here's the issue that I want to make sure that you understand, if you've got equity in your home and you can afford the original note payment. So let's just use some numbers here. Say you've got a house that's now worth $1.2 million. And I know that's not very far off from being median home prices here in Southern California. But you've got a house worth $1.2 million and you owe $600,000 on it. That means you have $600,000 in equity. Now, if you qualify, let's just say for an $800,000 loan, I'm not suggesting you take $800,000. You're going to pay off the $600,000 that you currently owe, but it may be that the payment on that, even though the interest rate is higher, the payment might be lower. And I know that sounds counterintuitive, but the important thing that I'm writing, and you can see all of that, how it works when you go to rsrhomeselect.com. Just take my word for it right now, but you can do your own research at RSR Home Select. But here's the issue. Now you've got $200,000 of liberated equity. And what I mean by that is you don't have to take that money, but let's just say you lose your job unexpectedly, or you have a health issue that was not expected, and now you can't work. Well, first off, the loan on the Home Select program is really an interest-only loan. You only have to pay your interest. But when you operate it the way it's meant to operate, you're going to be out of it very, very quick. You're going to be, most of the time we see it's about 7 years and you've got your loan paid off. Now, don't hold me to the exact numbers. Your situation will be unique, but it's right around 7 years paid off. But I digress. Let's go back to that concept of losing a job. Well, you've got all this equity in your property that's available to you. So if you don't make the mortgage payment, you don't worry, because some of your equity will go to making that interest-only payment that you're responsible for. You're not stressed. You can go and write a check or use your debit card out of the account and buy groceries, so you're not stressed. You can use that to go and put gas in the car so you can go find a new job or get retrained. These are all some of the benefits of the Home Select loan from Geneva. Again, take a look at it. Could be the last home loan you ever have. rsrhomeselect.com, rsrhomeselect.com. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, what's next for home prices and mortgage rates? Ways to establish a FICO score without applying for a credit card, things to consider before getting an adjustable rate mortgage, and more. Reach me anytime off air, number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Hey there, friends. Wondering if now is the right time to buy a home? Or are you waiting for a bunch of foreclosures? The facts speak loud and clear. Defaults and foreclosures are down. Sure, we might be headed towards a recession. But did you know interest rates typically drop and real estate values often go up during a recession? So what are you waiting for? Higher prices or higher payments? Don't navigate these waters alone. Connect with RonSiegelRadio.com today. That's RonSiegelRadio.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Their real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. What's next for home prices and mortgage rates? That is our subject. What's next for home prices and mortgage rates? If you're thinking of making a move this year, there are two housing market factors that are probably on your mind. Home prices and mortgage rates. You're wondering what's going to happen next and if it's worth it to move now or better to wait it out. The only thing you can really do is make the best decision you can based on the latest information available. So here's what experts are saying about prices and rates. Number one, what's next for home prices? One reliable place you can turn for information on home price forecasts is the Home Price Expectation Survey from Fannie Mae. A survey of over 100 economists, real estate experts, and investment and market strategists. According to the most recent release, experts are projecting home prices will continue to rise through 2028. If you're watching us on RonSiegelRadio.TV or any of our social channels or the ABC News and Talk AM 1490, FM 98.1 video feed, you're seeing a chart of home prices, of what the Home Price Expectation Survey says about home prices over the next 5 years. It's estimated price performance December as forecast Q1 2024. 2024, they're saying a 3.78% appreciation. This is national. Remember, California can probably double it for most parts of the state. 2025, 3.36. 2026, 3.87. 2027, 4.18. 2028, 4.11. While the percentage of appreciation varies year to year, this survey says we'll see prices rise, not fall, for at least the next 5 years and at a much more normal pace. What does that mean for your move? If you buy now, your home will likely grow in value and you should gain equity in the years ahead. But based on these forecasts, if you wait and prices continue to climb, the price of a home will only be higher later on. Number two, when will mortgage rates come down? This is the million-dollar question in the industry, and there's no easy way to answer it. That's because there are a number of factors that are contributing to the volatile mortgage rate environment we're in. Odetta Cushy, Deputy Chief Economist at First American, explains, quote, every month brings a new set of inflation and labor data that can influence the direction of mortgage rates. Ongoing inflation deceleration and slowing economy and even geopolitical uncertainty can contribute to lower mortgage rates. On the other hand, data that signals upside risk to inflation may result in higher rates, unquote. What happens next will depend on where each of those factors goes from here. Experts are optimistic rates should still come down later this year, but acknowledge changing economic indicators will continue to have an impact. As a CNET article says, quote, though mortgage rates could still go down later in the year, housing market predictions change regularly in response to economic data, geopolitical events, and more. So if you're ready, willing, and able to afford a home right now, give us a call at 800-306-1990, 800-306-1990. Couple of resources for you. rsrlinks.com/RVO. rsrlinks.com/RVO. That's a rent versus own analysis that we put out. rsrlinks.com/RVO. The other one that I'm going to have you look at is rsrlinks.com/market report. rsrlinks.com/market report. That's going to give you some idea of what's going on in the market you are in, because every market is unique. So I look at 92808 just for an example. It is one of the zip codes for Anaheim Hills. There are a grand total of 13 homes for sale in that area. Median list price is $1,575,000 this week. Last week it was $1,449,000. The week before that it was $1,512,000. Before that it was $1,678,000, $1,688,000. So they're changing all the time. New listings are at $1,575,000 is where they are. Again, there's not much inventory, and there are charts there that show you what the prices are doing, what the availability of real estate is. Again, if you go to rsrmarketreport.com, rsrmarketreport.com, I'm sorry, rsrlinks.com/market report, rsrlinks.com/market report. Thanks, Josh. You put it on the screen there for us. You're going to actually be able to put your zip code in. There's 3,007 zip codes in the United States. Put it in, and our friends over at Altos Research, they track every home for sale in the United States every week, and they're always putting that most current data in there. So you can go and get that anytime you want. Also, remember our slogan, strategy beats rate always. Strategy beats rate always. And the reason I bring that up is right now, believe it or not, rsrhomeselect.com. That loan strategy actually has the highest interest rate we have and the lowest interest expense. What's the difference between interest rate and interest expense? Because I have so many people say, well, Ron, you can't have the higher interest rate and a lower expense. Yes, you can if you have the right strategy. rsrhomeselect.com shows you the strategies, because on one of them we looked at last week, an $800,000 purchase, $640,000 loan amount. By using the Home Select loan, the family could save over $700,000 in interest expense. Try going out to lunch or dinner with a interest rate. The restaurant will not take it. Go out to lunch or dinner with Benjamin Franklin's. They will take as many as you want to spend. Interest expense is the Benjamin Franklin's. Interest rate you already know about. Strategy beats rate always. Bottom line, let's connect to make sure you have the latest information available on homes, prices, and mortgage rate expectations. Together, we'll go over what the experts say so you can make an informed decision on your move. That's the Real-Time Real Estate segment, brought to you by rsrmoney.com, rsrmoney.com. Let's see, what do we have else on our agenda for today? Let's do the Borrow Smart, Josh. Borrow Smart segment brought to you by rsrdebtfree.com, rsrdebtfree.com. 6 things to consider before getting an adjustable rate mortgage. Yeah, you got to think about these, because I'm going to share with you, in almost every instance, an adjustable rate mortgage is better for you than a 30-year fixed rate mortgage. You're not going to keep your loan for 30 years. Very, very few people do. On average, about 5.2 years. Take the number of loans out in the market divided by the number of people refinancing. You can kind of get an idea. About 5.2 years. Home buyers might be drawn to adjustable rate mortgages when interest rates are high. These loans tend to start with a lower rate than the more common fixed rate mortgages, which can lead to lower monthly payments and make buying a home more manageable. With talk of interest rate decreases on the horizon, some buyers may also plan to start with an adjustable rate mortgage, also known as an ARM, and then refinance with a fixed rate mortgage later. The approach might help you save money, but make sure you understand how ARMs work and the potential risks before opting for this route. Number 1, how adjustable rate mortgages work. The adjustable rate mortgage, ARMs, often have a 30-year term, similar to common fixed rate mortgages. However, as the name suggests, the interest rate can change during this time. The ARM's interest rate depends on an index rate, such as a secured overnight financing rate, SOFR, and a margin that the lender adds to the index. Your ARM's rate and your monthly payment can change when the index moves up or down. However, your mortgage won't change every month. Instead, ARMs start with a temporarily fixed rate period and then periodically adjust. These terms are included in the ARM's description. You'll see 2 numbers, X and Y, in the ARM's name. The X is the initial fixed rate period. The Y is how often the rate adjusts afterwards. So a 7-1 ARM has a fixed rate for 7 years and then adjusts once a year after that, while a 10-6 ARM has a fixed rate for 10 years and then adjusts every 6 months. There are various types of ARMs available, including options with fixed rates that last 3, 5, 7, or 10 years. Number 2, the initial rate and rate caps. Compare your loan offers to see how your rates and resulting costs vary with an ARM and a fixed rate mortgage. ARMs are riskier than fixed rate loans because your rate payment and payments can increase. So an ARM might not make sense unless you can save money. Additionally, review the ARM's interest rate caps, which determine how much the loan's rate can increase during the first adjustment, additional adjustments, and overall. For example, you might have a 7-1 ARM with a 5.25 cap. Your interest rate could change by up to 5% of the initial 7 years, and then could change by 2% every year with a lifetime cap. That's the third number, that 5.25. Tells you the maximum rate could increase. There may also be a minimum that the rate cannot fall below if the index drops. That would be the floor. Number 3, how long you plan to keep the mortgage. If you refinance an ARM before the initial fixed rate period ends, you'll never have to deal with the rate changing. Ideally, you can buy a home with a lower rate ARM, wait until interest rates drop, and then refinance into a less risky loan with a fixed rate. However, picking the right initial term can be tricky. ARMs with a shorter fixed rate period might offer the lowest rate, but you'll have to hope that rates drop quickly. A longer initial term might make sense if you're not feeling confident about rates changing, or if you plan to sell the home and move before the rate starts to change. Number 4, the cost of refinancing. Another factor that you need to consider is how much refinancing the ARM will cost. For example, if you save $200 a month on interest and it'll cost $2,400 to refinance, you might want to wait at least 12 months before refinancing. There are 2 main costs to consider. Closing costs. Your closing costs can depend on where you live, the loan amount, and the lender, but it may be around 2% to 6% of the loan amount. Shopping around and getting several offers to see who offers you a loan with the best terms and lowest fees. They never mention strategy. Strategy beats rate always. Premium payment penalties. Some ARMs might charge you a fee if you pay off the loan within the first several years. Look for an ARM without a prepayment penalty if you plan on refinancing. For the most part, we don't see too many prepayment penalties out there right now, but there are a few. Use the monthly mortgage payment calculator, ronismylender.com, to see how much an ARM might save you and compare the results to the potential cost of refinancing. Number 5, what happens if interest rates do not drop? Interest rates might be higher than in recent years, but that doesn't mean they're destined to drop. If you're considering an ARM, think through what you'll do if interest rates increase. For example, calculate what your payment would be if the rate increases to the ARM's lifetime cap. You could lose your home if you can't afford the higher payment, which might be a bigger risk than you want to take. Keep in mind, rising interest rates could coincide with other factors that make paying your mortgage or selling your home more difficult. Number 6, your eligibility for refinancing. Similar to getting a mortgage to buy a home, your eligibility could depend on your income, employment history, debt-to-income ratio, home equity, and FICO scores. And even if you can easily qualify for a mortgage today, your plan could go awry if you have trouble refinancing later. Some of these factors might be outside your control, such as a layoff or medical emergency. However, if you plan on taking out other large loans or leaving your job and starting a business, that might make refinancing more difficult. And obviously, you want to always be watching your credit scores. Make sure you are watching those credit scores. Cleanall3.com, cleanall3.com is my suggestion to you to watch your credit scores. You can also go to myfico.com, myfico.com. That's another resource for watching those scores as well. That is the Borrow Smart segment brought to you by rsrdebtfree.com, rsrdebtfree.com. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, 4 ways to establish a FICO score without applying for a credit card and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio, and broadcast. Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
79% of all credit reports have errors that should be corrected through factual disputing. You could be saving thousands every year if your report was accurate. CreditSanitizer.com provides a free credit report audit when you furnish a specific $1 credit report. You can use this information to request corrections to your report and potentially save thousands of dollars. Get your free credit audit at CreditSanitizer.com. That's CreditSanitizer.com for a free credit report audit. CreditSanitizer.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio. Or anytime at 800-306-1990, 800-306-1990. How medical debt can impact your credit score. That is the subject of Your Credit Matters today. being brought to you by rsrdebtfree.com, rsrdebtfree.com. Medical debt can negatively impact your credit score by increasing your credit utilization ratio, or if you don't pay off the debt by listed as a charge-off or an item in collections on your credit report. Medical debt can have a direct impact on your credit score in a few different ways. How it will affect your credit score will depend on a few different factors, like where you check your credit score. Number 2, how much medical debt you have. Number 3, how long you've had that medical debt. Number 4, if you fully paid off your medical debt. Number 5, if you're unable to pay your debt and it goes to collections. There have been recent changes made to the way that medical debt is reported on your credit report that may reduce the hit your credit takes. But the different rules surrounding medical debt mean that understanding its impact can be a bit more confusing. How medical debt can hurt your credit. The reality is that unpaid medical bills can affect your credit score if they're listed on your credit report. Unpaid medical debt can have an impact on your credit utilization ratio, which is the ratio of total debt compared to the amount of unused credit you have available. If you don't make payments on your medical debt, like other types of debt, your medical debt can be charged off and sent to collections. A charge-off and an amount in collections are both negative items that could impact your credit and your credit score for up to 7 years. Medical debt versus other forms of debt. If you currently have unpaid medical debt, you'll be happy to learn that there have been changes to the way this debt is recorded on credit reports. The 3 main credit reporting agencies, TransUnion, Equifax, and Experian, are changing the way they handle medical debt. For instance, Vantage 3.0 and Vantage 4.0 no longer consider medical debt when calculating credit scores. While FICO does still consider medical debt listed on a credit report, it holds less weight than other types of unpaid debts. How long does medical debt stay on your credit report? Unpaid medical debt can remain on your credit report for up to 7 years or until it's paid in full. All paid medical debt is removed from your credit report. However, the removal process can take up to 30 days to complete. Bills under $500 will not appear on your credit report. It's important to note that this doesn't relieve you from paying your medical debt. You still owe these medical bills, and medical debt collectors can still contact you. It only means this debt will no longer be part of your credit report. Medical organizations and collection agencies can still take other actions, such as court action, if you fail to pay this debt. How to get the medical debt off your credit report? Everyone makes mistakes sometimes, and credit reporting agencies are no different. It's important to regularly check your credit reports to make sure they do not include any errors. All 3 major credit reporting agencies allow you to request 1 free credit report each week. You can also check out your free credit report card to see how information on your credit report is impacting your credit score. If you believe any medical debt is listed on your credit report in error, you can take steps to have this debt removed. With the new reporting changes in mind, you should also take steps to have any medical debt that's paid in full, unpaid medical bills less than $500, or debt that's less than 1 year past due removed from your credit report. You can still file a dispute by submitting a credit challenge letter explaining the error along with any documentation to prove your claim. It goes directly to the credit reporting agency. These agencies are required by law to investigate all dispute claims. If these agencies find that the debt is listed in error, they'll remove it from your credit report. If you want to keep checking your credit report, again, cleanall3.com, cleanall3.com. You can check and get a real FICO score. I get so many people, the Vantage scores, the credit scores, the TransUnion 8, the FICO 8, those are all scores that are different, and they're not the ones that are going to be used for credit scoring, for FICO scoring purposes. Just throw that information out there for you. I think, do we have time, Josh, for another Your Credit Matters? Yeah, okay. He's shaking his head because he knows that I talk too much. Let's see. 4 ways to establish a FICO score without applying for credit is the subject of Your Credit Matters, brought to you by rsrdebtfree.com. A credit card can be a useful tool when you're ready to establish a FICO score for the first time. But if you prefer to build a FICO score through different methods, you'll be happy to learn that it is possible to build good credit without a credit card as well. If you don't feel ready to open a credit card yet, the alternative options might help you begin your credit journey in other ways. Number one, credit builder loan. When you're building credit from scratch, it can sometimes be difficult to qualify for your first credit accounts. Without existing credit history, lenders may be hesitant to take a chance on you and approve you for certain types of new financing products. A credit builder loan could be a good solution to consider when you have no FICO score or thin credit file. This type of loan is designed to reduce the lender's risk, so it may work well for people who have no established credit or even those with bad credit. With a credit builder loan, the lender does not give you the money you borrow directly. Rather, there's a waiting period. One common method for lenders who issue credit builder loans is that they place your funds in a savings account or certificate of deposit, a CD. You repay the lender monthly, and once you make your final installment payment, the lender releases the loan proceeds minus any fees. Depending upon the lender, you might even earn interest on the loan proceeds it holds in savings until you pay off the loan. But the interest that the lender charges typically offsets any interest you may earn. Of course, the biggest potential benefit of a credit builder loan is the potential to establish positive credit history. So it's important to find a lender that reports activity to all three credit bureaus, Experian, TransUnion, and Equifax. Number two, installment loans. It's not a good idea to go into debt for the sole purpose of establishing credit. But if you need to borrow money for other reasons, the installment loans you open may have the potential to help you build your FICO score. An auto loan is one type of installment loan that could help you build a FICO score if you manage it in a responsible manner and the lender reports the account to the three major credit bureaus. Even with little to no previous credit history, this type of loan might be easier to qualify for than some other types of loans. Auto loans are backed by collateral, also known as the financed vehicle, that the lender can repossess in the event of a default. The collateral reduces the lender's risk. Therefore, borrowers with limited credit, no credit, or even poor FICO scores may find it easier to qualify for auto loans with some lenders. Note that as you work to improve your FICO score, you could increase your approval odds and save thousands with lower interest rates and better borrowing terms. Number three, rent reporting. Paying your rent on time is a good habit to establish, but if your landlord doesn't report your rent to the credit bureaus, that positive payment history does not have the ability to help your credit score, your FICO score. Credit scoring models only consider information that appears on your credit reports. As a consumer, it's not possible to add information to your own credit report, yet there are third-party rent reporting services that might help share your rental payment history with one or more of the credit bureaus on your behalf. Some rent reporting services are free. Others charge a fee. Additionally, some rent reporting services do not share information with all three credit bureaus. Therefore, it's important to do your own research to nail down these important details. Here's a few third-party services you may want to consider. Experian Boost. You can use this free service to add rent payments along with eligible utility bills, mobile phone bills, and streaming services to your Experian credit report. Pinata. Free app allows renters to have their rent payments reported to TransUnion at no cost. Self. This free service helps users report rent payments to all three bureaus. A premium rent plus bills service is also available, including bill payment to TransUnion credit monitoring and additional services, $6.95 a month. Rent reporters receive 24 months of back rent history with Equifax and TransUnion, plus ongoing rental reporting. To join, the company charges $95 sign-up fee. Could be broken up into three payments of $31.65, plus a monthly fee of $9.95. Number four, authorized user status. Another possible way to establish a FICO score without opening a credit card of your own is to become an authorized user on a friend or family member's account. If the card issuer reports the account to credit bureaus for both you, the authorized user, and along with the primary account holder, there's a chance it might benefit you. Keep in mind, it's best to ask a family member or friend to add you to an account that is well managed with a positive payment history, low credit utilization, and it's old. If you become an authorized user on a credit card with late payment history or high balance to limit ratio, the account might hurt your FICO score rather than benefit. Bottom line, smart credit management habits can help you establish a FICO score over time with or without a credit card on your own. Yet, no matter what type of credit account you open, it's important to follow sound credit management habits. You can find those rsrccpayment.com, rsrccpayment.com. Pay the credit card bills the right way, understand how to use it, and help your FICO scores. That's Your Credit Matters, brought to you by rsrdebtfree.com, rsrdebtfree.com. And as always, we ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean, who are engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.